Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. A new GDP report, a new term for Ben Bernanke, and the January effect. That's what we're talking about on this edition of the Roundtable with our editor-at-large, Steve Reitmeister, research director Shiraz Mian, and that top market technician, Kevin Matris. Welcome back, by the way.
Thank you. It's been a couple weeks.
Yeah, it has been a while. So we're going to start with you,
Okay.
because you're back in the proverbial saddle here.
Okay.
Best economic growth in 6 years during the fourth quarter of 2009. However, for the year as a whole, the economy did shrink by 2.4%. So is this report really good news?
Well, you can see that the market didn't think so, given that it continued its ongoing sell-off, or at least it didn't think so at first. There's a couple, on the surface, great number, 5.7% versus, I think it was about 4.5% expectation, so blows away expectations. Anytime you have any number like that, you got to say to yourself, wow, we're having some economic expansion. When you dig into the numbers, there's a couple question marks in there.
Right.
That a lot of the growth came from the change in inventories, which doesn't have the greatest long-term benefit. But overall, it's kind of hard to take a look at that number, no matter what's lying underneath, and say that we're not having economic expansion. And that I think, as we were talking this morning, the market's rallying about at 1%. And I think that people are saying, on the grand scheme of things, this is good news. The economy is going the right direction. And this recent market tumble probably is a bit overdone.
Kevin, what do you think, though? We're probably going to see a revision here sometime in the next month, right?
Probably.
Down to like a growth of 1.5 or something?
Well, I think that's the big thing. The 5.7 was a great number, way above the 4.5 and sharply above last quarter's 2.2. But, everybody is wondering what this 5.7 is going to get reduced to, because if you take a look at Q3, I think that came in at 3.5 with the preliminary number. But there's two more revisions. 2 revisions later, they chopped it up by a third, and it ended up at 2.2. So I think right now everybody is wondering, is 5.7 the last word on Q4? I don't think it is. And I think now the big guessing game is how much lower Q1 is going to be than Q4. But I do want to say one thing. A lot of people are pointing to this inventory thing, saying that because there was such a huge portion of that GDP number coming from inventories, that somehow this is being completely discounted. I think that inventory rebuilding is going to add to GDP for quite some time, because think about it. We've had a record drop in inventories that lasted more than a year. It's going to take a lot more than just 1 quarter to get us back to normal levels.
So they claim, and by they I mean the people who obviously know more than I do about this kind of stuff, economists, right? He said, tongue-in-cheek, because, well, economists are a whole different conversation, but inventories are a driving force in recoveries. Yeah. So I don't know. Whether or not that argument gets resolved favorably, we'll just have to leave that for another time. But Shiraz, let's assume, for the sake of discussion here, that the revision is downward, but not as strongly as we're all kind of speculating. And the number for growth in 4Q remains a good number, right? Positive number. Does this mean that our economy can keep growing at this strong pace here going through the year?
I don't think that's even built into the very optimistic expectations in the market. Everybody knew this will be a one-off, very strong quarter. The economy actually produced a number which was even better than some of the optimistic expectations. And I am, on balance, more optimistic and positive about this report than Steve and Kevin. Coming into the numbers, everybody was expecting that it's going to be 60% to 2/3 to up to 70% of the growth will be coming from this inventory effect. Mm-hmm. In the end, a couple of the other components, which are more leading in nature, and
exports being one.
Exports being one, the investments by businesses being another one, the contribution to growth from those components came in better than expected. Yep. We need growing contribution from those sectors once the fiscal stimulus runs off towards the end of the second half of the year, and that's a good sign. So the fact that the overall headline number came in so better, the fact that we had good contribution from a couple of these other areas, which we were not expecting, is another good sign. So on balance, I feel very good about the fourth quarter GDP number, and the revisions scenario, it's always uncertain. It was more uncertain in Q3 than it's going to be in Q4. Remember, Q3 was the first positive GDP growth coming out of a very long recession.
Right.
It's always difficult to get that first read right when you are at such inflection points. Now we are in a growth momentum. We will slow down from this faster growth rate in Q1 and Q2, but we are in positive territory, so the revisions should not be as drastic as we have seen in the past.
Okay. Let's move on to the new Fed chairman,
Okay.
who's the old Fed chairman, revisited. What do you think about this reappointment?
I think this was a no-brainer. I think that far too often we find society that we forget, this guy inherited the problem. Okay, so in other words, he's getting labeled with, well, look at the aftermath. Okay, well, the aftermath of this horrible situation that he inherited. When at the time, when you consider the speed at which he worked, the creativity of the different moves that he and the Treasury Department pulled off in terms of getting this economy stabilized, and I think at an incredibly fast pace, to only end up here at 10% unemployment when I thought 15 was a possibility, okay, and beyond. That on the whole, yes, we are in bad shape right now, but I could imagine it being a lot worse. And so he has to get some of the credit for the speed and creativity to get us to a point of stabilization.
But Kevin, I think what a lot of the people on Main Street are still frustrated over is that he still represents Wall Street, the folks who got us in this trouble in the first place, in their minds.
There's so much blame to go around, not the least of which is Congress, several administrations even prior to this one, both a Democrat and Republican. Bankers got us into this mess. Even consumers, we are also culpable as well. But again, we have to look forward, and I think the entire financial community and world financial community has breathed a sigh of relief because I can't think of anybody on the stage right now who is more capable of being able to steer this economy into a better direction.
Shiraz, you concur?
Absolutely. I think I all along thought this discussion about his confirmation and not getting enough votes, I thought it was high drama, the typical Washington thing. Nobody doubted that Bernanke was somebody who literally wrote the book on the Depression. And the economy, the monetary system, Wall Street plus Main Street were in better hands with him running the shop than anybody else.
All right, Steve, I want to give you the last word on this January effect because
Okay.
if my memory serves me correctly, you don't really put a whole lot of stock in as January goes, so goes the market for the rest of the year.
Every year is different. And the fact is, if you take a look at most months throughout the year, most months are positive. So to say that because January, whatever January goes, so is the year, well, most months are positive. I think that that the market just rallied and rallied and rallied and rallied, rallied, and that they decided in January was time to cool off. So because January is down, will the whole year be down? I don't think necessarily the case. I don't think we're set up for a gangbuster year anyways, but I felt that way before January. I felt because most of the gains were made in 2009. So we had a little bit of a sell-off, okay, no problem, and here we are. GDP looks terrific, and the market's off and running in February, so maybe as February goes.
So maybe it was just time for normal profit taking in the cycle?
Yeah, absolutely. Was it 8 straight months of, or 9 straight months of gains, the market? I mean, how often do you have that? So it was time.
All right, so it goes here at the round table with all these guys. I'm Terry Ruffalo.